I regularly see retirees paying more taxes in their 70s than they did when they were still working, not because of bad investment decisions, but because retirement income works so differently than most people expect. A lot of people assume their taxes will automatically go down once they retire, and sometimes they do, but many times that's not what happens. My name is Dustin Rudolph. I'm owner and president of Legacy Ascent Wealth, and I work with retirees and pre-retirees to build income plans that are tax efficient, intentional, and built to last. Over the years, I've seen a pattern. People who saved well, built strong portfolios, avoided debt, made thoughtful decisions, and yet they still end up paying far more in retirement than they expected, not because they were reckless, but because no one had helped them connect the moving pieces. Social Security, IRA withdrawals, Roth conversions, Medicare premiums, and what happens when one spouse passes away. And that last one catches people off guard more than anything. So today, I'm walking through 6 different tax mistakes I see over and over again in one of the most overlooked traps in retirement planning, the widow tax problem. Because retirement planning isn't just about if you can retire, it's about how your income shows up, how much of it you keep, and whether the plan still works when life changes. Before we jump in, I want to clarify something. The goal in retirement planning is not to eliminate taxes completely. That often leads to worse outcomes. The goal is to be intentional, because over a 20 or 30-year retirement, taxes may be one of the largest expenses you face. And when retirees overpay, it usually isn't because of one bad decision. It's because no one was coordinating the full picture. Let's start with mistake number 1, waiting too long to start tax planning. One of the biggest mistakes I see is waiting until required minimum distributions begin before thinking seriously about taxes. People retire, income drops, and they assume they'll deal with taxes later. But later is often when that flexibility disappears. For many retirees, the most valuable planning window is the stretch of time between retirement and when income becomes forced. The paycheck may have stopped. Social Security may not have yet started, and required minimum distributions may still be years away. That window is where some of the best planning opportunities exist. Now, Social Security has started. Now, required minimum distributions begin. Maybe pension income is present, and dividends and income start to stack up. Now you're trying to manage taxes with far less room to move. The mistake is not paying tax. The mistake is waiting until your choices become narrower. A good retirement plan asks a simple question: where are the years where we still have control? Because that's where the real planning happens. The second mistake, making Social Security decisions in isolation. Mistake number 2 is something I see very smart people get wrong. Many retirees treat Social Security like a separate decision. Should I claim at 72? Wait until full retirement age? Delay till 70? Those are important questions. But Social Security is not just a claiming decision. It's an income coordination decision. Once Social Security begins, it affects everything else. It affects how much pressure is placed on the portfolio. It affects how much room exists in Roth conversions. It affects how much taxable income appears, and it affects what happens later for the surviving spouse. The mistake is not always claiming too early or too late. The mistake is making the decision without coordinating it with the rest of the plan, because retirement income decisions don't happen in isolation, they ripple. The third mistake, ignoring Medicare IRMAA. This is one many retirees just don't see coming. They assume Medicare is simply Medicare. Then premiums increase and they're wondering what happened. This is where IRMAA comes in, income-related monthly adjustment amount. If your income rises above a certain threshold, your Medicare premiums increase. And many retirees trigger IRMAA accidentally, not because they made a terrible decision, but because no one was watching the full picture. Maybe a large Roth conversion happened. Maybe appreciated investments were sold. Maybe several income sources simply stacked together. Now, avoiding IRMAA at all costs is not the right move. Sometimes paying more this year still produces a better long-term outcome, but that should be intentional. Retirement income planning isn't just about your tax bracket. It's about every place your income shows up and every consequence it creates. If this kind of planning is helpful, subscribe. Each week, we break down retirement income decisions that can materially affect how much retirees actually keep. All right, let's move to mistake number 4. Treating Roth conversions like they're automatically good. Roth conversions are one of the most talked about strategies in retirement planning, especially on YouTube, but they're also one of the most misunderstood. Somewhere along the way, Roth conversions started being treated like they're automatically a good move, and they're not. A Roth conversion is only good if it improves the long-term outcome of the plan. That means asking questions like, what tax bracket are we converting in today? What might future tax brackets look like? Will this create Medicare IRMAA surcharges? How does this interact with Social Security? And are we reducing a future RMD problem? Does this help protect the surviving spouse later? The goal is to improve the retirement plan over time, and that leads to something I want you to pay very close attention to. Let me pause for a second, because what I'm about to explain may be the most overlooked issue in retirement tax planning. Imagine a married couple entering retirement with much of their wealth in traditional IRAs. While both spouses are still alive, the plan may look manageable. They file married filing jointly. They have wider tax brackets. They may receive 2 Social Security benefits. Withdrawals and investment income appear manageable. But eventually, one spouse passes away. And here is where the problem appears. Income often does not drop nearly as much as the tax brackets do. The surviving spouse may keep the larger Social Security benefits. IRA withdrawals continue. Investment income may still be present, but the tax brackets, they shrink dramatically. Now, the surviving spouse files as a single instead of a married filing jointly, which means the same income may reach higher tax brackets much faster. That's the widow tax trap. Income doesn't fall nearly as much as the tax brackets do. And that's why retirement planning should never only focus on what works while both spouses are alive, because eventually, one spouse will likely be managing the finances alone under a very different tax structure. Mistake number 5, taking income from the wrong accounts. Another mistake I see often is treating withdrawals like a simple cash flow decision. We need money, let's take from this account. But where income comes from matters. IRA withdrawals create ordinary income. Roth withdrawals may create none. Taxable accounts create capital gains, or sometimes very little tax, depending on the cost basis. What often happens is retirees default to the easiest account instead of the most strategic one. Withdrawals are not just cash flow decisions. They are tax decisions, they're Medicare decisions, and survivor planning decisions. Mistake number 6, only focusing on this year's taxes. This final mistake ties everything together. You may say, I don't need a financial advisor because I have a CPA or a tax accountant. Well, they're focused on one goal, this year. And many retirees make tax decisions are with that one goal. How do we pay less tax this year? But minimizing taxes this year is not always the same as minimizing taxes over retirement. Sometimes paying more tax today reduces a bigger problem later. Sometimes recognizing income now reduces future RMDs later. Sometimes a Roth conversion increases today's tax bill but protects the surviving spouse later. Avoiding tax today can simply push the problem into years where flexibility is lower. The goal is not short-term tax avoidance. It's long-term tax coordination. When you take a step back, the biggest retirement tax mistakes usually come down to a few patterns. Waiting too long to plan. Making Social Security decisions in isolation. Ignoring Medicare IRMAA. Using Roth conversions without a long-term strategy. Missing the widow tax trap. Taking income from the wrong places and focusing only on this year instead of the entire retirement timeline. Notice something important? These are not usually investment mistakes. They are coordination mistakes. A good retirement plan shouldn't just tell you whether you have enough assets. It should show you how those assets turn into income and how much of that income you can actually keep. Every one of these issues plays out differently depending on your specific situation, your income, your accounts, your tax brackets, your goals. That's why retirement income decisions, whether it's Roth conversions, Social Security timing, or withdrawal strategies, should always be made within the context of a full plan. If you'd like some help walking through that kind of planning, there's a link below where you can schedule a consultation with our team at Legacy Ascent Wealth. And if this was helpful, click subscribe. Each week I break down retirement income planning, tax strategy, and Social Security, the decisions that ultimately determine how much of your retirement income you get to keep. Until next time, plan intentionally.